Managers don't own the assets of a corporation, but they are held accountable for the use of those assets. For example, managers don't own the airplanes for an airline, but they are held accountable for the airline making money using those airplanes. They don't own a manager doesn't own the building or the equipment in a restaurant, but a restaurant manager is held accountable for the restaurant making money using those assets. A department store manager might not own the inventory or the building, but the manager is held accountable for the department store making money using those assets. So who holds them accountable? Well, ultimately in a corporation it's going to be the stockholders. Now, how are they held accountable? Well, to some level they're going to be held accountable by their performance of the financial statements. So in this lecture we're going to get a better feel for those financial statements and the impact managers can have on those financial statements. So let's start by looking at the financial statements that are in question, right? First of all, we have the balance sheet. And in general, what you're going to see on the balance sheet are the resources, which in accounting we call assets. Now those resources have to equal the liabilities. A liability is an obligation of the organization, right? Something that the organization owes, plus the equity in the business, meaning the amount of investment that has been put into the business. We call that equity. Because it's a corporation, we're going to call it stockholders' equity, because the stockholders are the ones that put that investment in the business. So the assets are the resources that the managers have to use in order to generate profit. And so they're held accountable for taking those assets and earning a profit. We look at an income statement as a way to determine the profitability of the business. So an income statement has revenue, and then it subtracts from the revenue expenses. And from that you get profit. In accounting we call that net income. So that's just a general overview of the two financial statements. And even though they seem fairly simple, there's a lot of complexities that go along with these, right? There is a dynamic between the two, right? So the idea of revenue is taking the assets and generating more assets, meaning generating cash, which is one of the assets a company has. So taking the assets and generating more cash, they call that revenue or income. Often you see the definition of revenue as the income produced from sales of products or services. And that's okay, but then you have to ask yourself, well, what is income? So ultimately the income is going to be the cash that's generated from the use of those assets. That's what's going to ultimately be your income. But there's a big question there, and that is the timing. So we're going to get into that. But you can see that there's a dynamic here between the balance sheet and the income statement. The balance sheet is useful for providing the value of the assets. The managers use those assets, generate revenue. That relationship between the balance sheet and the income statement is called articulation. So one of the big questions that we have is the timing. When a manager makes a sale, or when the organization the manager works for makes a sale of either a service or a product, we have to determine when we're going to put that sale on the income statement. Is it just when the asset is received, in other words, just when the cash is received, or is it when the business has done what they are promised to do? In other words, if you are selling sunglasses, you provided the sunglasses to the customer, but the customer hasn't paid you yet. Maybe the customer owes you and is going to pay you later. So when is that timing is what they call revenue recognition. And the counterpart to that is expense recognition. All right, so when to put the revenue on the books, that's revenue recognition. And then expense recognition has to do with the cost associated with generating the revenue. When do we recognize that on the financial statement? And this is important because that timing is going to impact the net income, the profits of the business, and remember, the managers are held accountable for the profitability of the organization. So the timing of when the revenue goes on the income statement or the expenses go on the income statement is an important consideration for managers. There's two basic methods that we're going to consider for how we're going to recognize revenues and expenses. One method is called the cash basis, and the other method is called the accrual basis. Right, so a cash basis situation means that revenue is recognized when you have the cash in hand, and not until then. An accrual basis means that the revenue or expenses are recognized when the work is performed. Sometimes this is not a big deal. For example, take the restaurant. Let's say a customer comes in, eats a meal, pays you. So the revenue is, you've earned the revenue at the same time that you've gotten the cash transaction. When that timing is at the same time, it doesn't present any kind of issue. But what about the situation where there's a difference in the timing, where there's a disconnect? For example, let's say the restaurant also does catering, and let's say they do some catering services for a customer and then bill the customer later. So they've already done their part. They've already provided the service and the food, and now they're waiting to receive the cash. So at that point, there's a disconnect between when the accrual basis would recognize the revenue. The accrual basis would recognize the revenue as soon as they provided the service. But the cash basis would wait until the cash is received. There's a difference there on the timing. Or on the other side of the coin, what if a customer paid them for a wedding that wasn't going to be held for 2 more months? When should that revenue go on the income statement? Should it go the time they receive the cash, or in 2 months when they do the work? Depending on the basis that the company uses, it's going to determine how the profitability for the company looks. Even though it's a timing difference, timing is a very important element, especially for management, as we all know. Let's look at an example. So I set up a little example here with a gymnasium you buy memberships with, Summerdale Gym, right? You go in, you work out. You pay for the membership, right? So under a cash basis situation, let's say in 2020 they start the business, right? And they buy some machines. So they spend some money, let's say $300,000, and we'll just knock 3 zeros off. So $300 means $300,000, right? The expenses, the cost of operations, is $60,000 a year. Okay, so we have, let me make that $sign. So we have some memberships that we sold in 2020. The cost of operations is $60,000, and then we also took out a loan to get that $300,000. So we owe interest, but the interest isn't due until 2022. At that time, $33,000 will be due. So if you look at a cash basis, the memberships that we sold in 2020, let's say that we're just looking at those memberships. So those memberships come in 2020. They already paid, so that those members are not going to pay any more for the next 3 years. It's a 3-year membership. And the interest isn't going to be paid until 2022. The cost of operations will be the same each year. And so if we look at the operating income for each of these years, we're going to see the first year we're going to have $240,000. the next year we're going to have negative 60,000, and then the next year we're going to have negative 93,000. Based on, now I know we might sell other memberships, but we're looking at the impact of the memberships that we sell in 2020. Under the cash basis, you're going to see the impact of those memberships are going to be more in 2020 and less in later years. Let's compare that to the accrual basis. So under the accrual basis, we're only going to recognize the revenue when we've earned the membership from the members. In other words, if we sold someone a 3-year membership, we're not going to earn all of it in the first year because we still owe them membership opportunity, a place to work out, in each of the 3 years. So we only earn it when we provide that membership benefit to them. It still costs us the same. So it costs us $60,000 in this case to run the membership each year. And then with interest expense, we recognize the interest expense when it occurs. So even though we don't have to pay it out of pocket, the interest out of pocket until 2022, we're earning this liability of interest. We're generating this interest over time. So it's actually, generating. It's a simple interest calculation, nothing complicated here. It's generating interest little by little each year. So even though cash isn't coming out of our pocket, we're still having to owe that. We owe that interest, and we need to pay it at some point. So all right. So then when we look at the impact of operations, now we get a different story. Now we see that our net income from operations is much different. The same amount of cash has come in, but we recognize the revenue differently. The accrual basis is said to match the efforts and the use of the assets more accurately with the time period than the cash basis. At the end of the day, we still had the same amount of revenue, the same amount of expenses, the same amount of profit after 3 years. Either way we went, but the timing is different between those two. And if you don't think timing is important, ask the manager who's looking for the bonus in 2020 which method he or she would have been more interested in, right? The accrual basis is what's accepted by the FASB as generally accepted accounting principles, which we talked about in a previous lecture. This is a GAAP. This is allowed under GAAP. Generally, the cash basis is not allowed under GAAP. And the reason is because that matching. We're matching the use of assets and effort to the actual period better with the accrual basis than with the cash basis. Let's go back and look at the income statement in a little bit more detail. So if we look at the income statement in a little bit more detail, let's scroll down a little bit. We call this the income statement format, right? The format that we use for the income statement helps users assess, the amount, timing, the certainty or uncertainty of the eventual cash flows from profitability. So what we want to do is get a little bit more detail in this. So let's look at an income statement in a little bit more detail. This is not extremely detailed, but it's a little bit more detailed than we looked at before. So this is for a business that sells products either through manufacturing or through retail or wholesale. So they have a cost of goods sold, right? So the first thing that we can get from this information here is that we can figure out the gross profit percentage, right, by the percentage of gross profit to the revenue, and that helps us to understand how much markup and how much flexibility the managers have. We can also get a gross margin where we get the percentage We can also get a gross margin where we get the percentage of the of the gross profit to the revenue, right? Both of these are very useful to understand the type of business that we're in, right? Knowing what kind of market we have and how we deal with other competitors. If we are an investor or a creditor, somebody using this income statement, what we're trying to get a hold on is how we can predict future profitability based on the management's past performance, getting profits, right? Getting net income. And in order to do that, what we want to understand is the continuing operations of the business. In other words, things that are normal day-to-day elements of the business, because that's what we're going to expect in the future too. So when we look at the financial statements, what we want to ascertain is what is sustainable information versus transitory. So transitory would be situations that are temporary, that don't happen very often. So if we understand that, then we're capable of making a better judgment of the management's ability to generate profits in the future. And if you're a manager, you want to have an understanding of this so that you can make business decisions for how you're going to deal with your continuing operation. So the sustainable information that you have is your regular normal business dealings, like if you flying airplanes to take customers for an airline, or selling products at a store, for example, like CVS or something like that. These are regular, normal, dependable, and predictable. So we want to make sure that our income statement presents that to us in a way that we can get that information versus the transitory, which is unusual, infrequent, or discontinued. So in considering what's unusual or infrequent, this is some common examples. Floods, fires, disasters, a labor strike. If you have to write down the value of some assets, you have to write down the value of some inventory, or you have an exchange rate of currency in a foreign currency that was impacted for some reason, a corporate restructure, pardon my typo there, or the sale of some investments that you have. So those are things that you can't really depend on the future as occurring, whether they're good or bad. And so what you want to do is get a hold of the sustainable and understand on our income statement what the difference is between the sustainable elements of the profitability shown to us in the income statement versus the transitory, so that we can get a better understanding of the impact management has and what the impact management will probably or likely have in the future.